donating cash is generally the worst thing you can donate to a charity, but by far entrepreneurs donate cash more than anything else because it's the simplest.
Yep.
But remember that when you donate anything to a charity, you get a deduction based off of the fair market value. So you want to generally donate highly appreciated assets. So for example, if I bought stock in Tesla and it's gone up a lot, if I donate Tesla stock, I don't get a deduction on my tax return for what I bought it at, but what for the fair market value was at the date of contribution. But then on top of that, I don't have to sell the Tesla stock and pay the capital gain taxes on the growth, because when I donate it to a donor advised fund or to a charity, they sell it. They don't have to pay any taxes. They're a tax-free entity. So I think it's really important to first ground us all in that generally it kind of drives me crazy. Giving cash is generally the worst thing you can give to a charity.
Absolutely. And one just side note, and we don't have to go into great detail on this, but if you're getting QBI, qualified business income deduction, through your business, then you have a higher tax bracket in your personal world if you make a lot of money than in your business. So rather than giving to the charity from the business, which entrepreneurs often do, in that case, you're often better taking a distribution and then making the personal contribution to charity. A donor advised fund. Donor advised fund is very simple, easy to set up. You could set one up in a couple of days at any of the major brokerage houses, Fidelity, Schwab, wherever you want to set it up. Very low cost. And the great thing about a donor advised fund, because it's simple, low cost, but it works where you get to put in the money in the year you need the deduction most, and you can put in Tesla stock if you want to amplify that or leverage that by not paying the capital gains taxes. But you get the deduction the year you put the money into the donor advised fund, but then you get to decide when you actually give that to a charity. So for example, if you give $100,000 to a charity every year, that's your charitable gifts, and you had an enormous year and you've got an extra $1 million, you could put the $1 million into the donor advised fund, which would fund the next 10 years of your charitable contributions, but get the deduction in the year where you're in the highest tax bracket all across the board. That's the magic of a DAF or a donor advised fund. And many of our entrepreneurs utilize that. You can also name it the Bryce Keffler Family Foundation. Name anything you want. You can have your kids take it over at some point. That can be used for what I talked about, just a few seconds ago. If you want to once a year get together and decide how money should come out of the DAF and what charity it should fund. And hopefully you get your kids to do that after you're gone so that they continue that tradition, pass it on to their kids, and have all the grandkids get together once a year and decide where the money goes.
Yep, I love it. All right, let's talk through some charitable trusts. I love using the metaphor of the apple tree here when we were talking about charitable lead trusts and charitable remainder trusts. And the metaphor here is that you, as the entrepreneur, plant this tree. So there's a tree, and this tree produces fruit every single year. Let's call it apples. And what you get to decide, and it depends on whether you want to do a charitable lead trust or a charitable remainder trust, is I either get to harvest the apples or I get to keep the tree. Which of these do you want? And so in a charitable remainder trust, the way that it works is that you are harvesting the apples every single year, which represents cash flow. So you plant the tree, you put money in this trust, you get a tax deduction, and then every single year you get cash flow or distributions from this trust, which are the apples. But when you pass away, you leave the tree in the garden for future generations, for future charities. So that's the metaphor there for the charitable remainder trust.
Yeah, that's good. And charitable remainder trust, like you were talking about with Tesla stock, that works best if you put in an appreciated asset, because when it sells, there's no capital gain. So then you have a higher dollar amount or a bigger apple tree, creating more apples than if you had to pay the taxes and you'd have a smaller apple tree afterwards.
Yep, and we saw this with a client who had a private equity deal. It was an 8-figure deal. Put some shares in a charitable remainder trust ahead of the liquidity event. And so then what happens is they sell the shares. Then that's a tax-free transaction. So the charitable remainder trust is the one that sells it, pays no taxes. And then there's income that gets spit out every single year to the entrepreneur. And then the remainder amount is going to go to a donor advised fund that will be controlled by the entrepreneur's kids. Now, when that money comes out every single year to the entrepreneur, that is taxable, so that you do pay your income taxes, but you spread it out over a long period of time, and you essentially are creating your own pension plan. Is the way that you're doing that.
Yeah, cool.
So that's a CRT, charitable remainder trust. The charitable lead trust is the inverse. That's essentially saying that, hey, I'll give the apples every single year to a charity of my choice or to my donor advised fund. But then after this term, whether it's 10 years or 20 years, whatever amount is remaining here, which is the tree, is going to go back to future generations, or it's going to come back to me individually. So the charitable lead trust is very, very powerful in low interest rate environments because you can get a huge tax deduction up front. You get to give money to charity every single year for 10 or 20 years. And then whatever amount is left there at the end of that term comes back to you. And we saw this was very popular in 2020, 2021, when interest rates, the Section 7520 rate was super low, around 2-3%. You could get 8%, 10% in your different investments. And if the IRS's rate was only 3%, again, anything above that amount would compound and be coming back to you at the end of the term. So charitable lead trusts were super important or super valuable in those low interest rate environments.
Yeah, and that one thing about the CLTs is you can do those post-exit.
Yep.
You can put cash into a CLT, often is what people put in there. So that is one of the after sale strategies that can work in the year of sale.
Yeah, and working with an entrepreneur right now, they do tithing of 10% every single year. They're in the year of a liquidity event right now, and so they're going to be putting about $5 million into a charitable lead trust. That's going to be the tithing gift this year. Now that $5 million isn't going to go to charity right away. It's going to be a 20-year term. So over 20 years, that money is going to get distributed out. But that was important because the church actually could not handle a $5 million gift up front because their operating budget isn't big enough that it would actually kind of ruin the church. They would probably spend a little bit too much money and not be smart with it.
Yeah.
So it was actually very intentional that the church, there's a very specific church that's going to be the beneficiary here, but they're going to get that money over 20 years. So they can now build this into their planning if they have a consistent cash flow coming in over the next 20 years, but it's not a $5 million check up front, which would probably encourage them to, like I said, not be great fiduciaries with their capital.
Yeah. And then of course, there's family foundations, which now you're talking about almost where you want to operate a charity, you want to provide services, and there's some deduction limits with a family foundation. They're more expensive, they're more complicated. However, if you wanted family members to actually work in the family foundation, you can pay them W-2 wages and all those kinds of things. That's something that you really have to be committed to services and to running a business. It's like running a business, having a family foundation if you do it right.
Yep, got to file the 990s. It's all public. All the financials are public, so there's no hiding behind any of that kind of stuff. But it does give you a lot of flexibility and to employ some of your family members.
Yeah.